Hey, good morning, everyone. Marty Mazzara here, December 4th, 2021, with your weekly macro update. I'll make it quick because I want to get on to more market-related stuff. I've been talking a lot lately about the internals, the technicals, and so on. It's been a few days since we've done a technical update on the video, so I'll do that, if not today, over the next couple of days. In the meantime, let's take a look at what's going on in terms of overall general conditions. And here's our index. Took just over a 4-point dip lower, just a little tick lower, with a score of 31.24 on the week. On the morning note yesterday, I touched on yesterday's November jobs number. Here are some of the things that we track. Non-farm payrolls actually came in quite below expectations. They were expected to be above 500,000. Now, note that these BLS numbers tend to get huge revisions. So let's look for this to get revised notably higher. There's also, I think, some seasonal adjustment there that may be a little bit out of whack, because we do know that a lot more than 210,000 jobs were created. And we know that from the household survey, which came in with a whopping 1.3 million. So that sounds a little bit high. So who knows, maybe that'll get revised lower. But overall, I would say it was a strong report. We had unemployment dipped to 4.2. We had average hourly earnings move at almost a 5% year-over-year clip. These are from another source. This is the quits rate. This is part of the job openings and labor turnover report. But since we're looking at this, I'll talk about that again. So quits rate of 3.0 is record high. And folks, when people are willing to quit their jobs, they do it because they think something better is in the offing, or they have something already set up. So that's considered actually bullish for the economy. An incredible number of job openings, 10.4 million remain. Back to Friday's number, labor force participation rate went up a bit to 61.8. And the U6 unemployment rate, which includes marginal workers, people who are working part-time but would prefer to work full-time, that's dropping to a comfortably low 7.8 relative to history. So overall, I'm going to call it a good jobs report. U.S. auto sales came out last week, and they dipped to 12.8 million. That was below an estimate of about 13.5 million. Pretty ugly number, but we know that it has as much to do with lack of supply as it has to do with folks' lack of interest in buying a car. I will say, however, that despite the fact that cars have clearly been in demand in excess of what the supply has been, when you read the consumer surveys, they continue to say that it's like the worst time ever to buy a car, is how people feel about it. Doesn't mean they're not willing to do it. They just think they're paying a pretty high price for them relative to what they've grown accustomed to. And of course, that's happening in many more places than just automobiles. Mortgage purchase apps continue to move up nicely, and that's showing up as a positive in our index. I will say, however, that refinances actually rolled over quite a bit, down 15% week over week. And that, of course, reflects rising average mortgage rates. Consumer confidence, folks, this one continues to bother me. Now, what I hear from people, and I don't get out much, but my wife and friends and so forth are saying it's definitely busy enough out there in the malls and so forth. I was talking to some friends the other day, and they were in Southern California, and they said it was just absolutely booming down there. So I explained to them that that's interesting because it's kind of inconsistent with what we're seeing in the consumer sentiment numbers. They just are not reporting a lot of optimism going forward. Of course, a lot of this is angst over inflation. And there's kind of a school of thought out there that people are saying, we've been pent up for so long. We have money in our pockets, and we're going to go out and spend it. And folks, I mean, we need to be very cognizant of the fact that while wages to the tune of like $300 billion were lost since COVID, something like $1.5 trillion of direct government injections into folks' wallets was there to replace it. So we've got 5 times in the aggregate the income lost, and of course, lots going to happen. Lots going to happen in terms of the retail space. Lots going to happen in the markets and so forth. And we have to, of course, discuss the unwinding of some of all that liquidity. And as you've noticed, the market's kind of struggling with that of late. The all-important ISM's Institute for Supply Management, Manufacturing and Services surveys for November Slight tick up in manufacturing, ramp up in services, all-time record for that particular survey at a 69.10. Let me just read briefly for you from the reports. Looking at the services report, November registered another all-time high, 2.4 points above October's reading, which was a former all-time high. Previous records were set in March and May and July. The data explains the elevated reading as 2 of the 4 equally weighted sub-indexes directly factored into the composite index set or tied all-time highs. The business activity index reached 74.6 and the new orders index reached 69.7. The supplier deliveries index hit 75.7%, which was the same as October. All-time high was 78.3 last April. Kind of in a nutshell, demand continues to be strong. Backlog of orders is slightly lower. The price index reached its 3rd highest reading ever at 82.3, and this October's figure was 82.9. Service businesses continue to struggle replenishing inventories as the inventory index and the inventory sentiment index stayed in contraction, or what they call too low inventory in November. And then when you read through the respondents' comments that they feature in the report, labor shortages, supply constraints, and so on and so forth. A little bit better at the margins, but we are a long ways from home in terms of the ability to get product to the marketplace at what would previously be considered a reasonable price. As for the manufacturing survey, 61.1, increase of 0.3 month over month, indicates expansion in the overall economy for the 18th month in a row, and so on. So I can just kind of stop there. It's a similar sounding report. Huge issues still with regard to supply constraints, labor challenges, and so forth. But all in all, a good report. Above 50 denotes expansion in the economy. Below 50 denotes contraction. So according to the ISM, so we're still in very good shape. And we have very low recession risk out there currently. Heavy truck sales ramped up nicely. That was good for a 1-point improvement in our index. Global Purchasing Managers Index, as I read through these and looked at the headlines and so forth, pretty mixed result. I'm surprised this wasn't flat, but it does say that there's been a slight increase in overall global sentiment from purchasing managers. Now, commodities, heavily influenced by oil, this is the Bloomberg Commodities Index, took quite the hit on that Omicron news. We had these flag patterns that were developing, pretty easy to draw here. Typically, a technician would use the flagpole as the next price target. And I'm just kind of using the same angle as we go. You kind of point these up from here, right? We pretty much got to the price target when you take even the smaller one here. If you use that and you use this one, this is going to go back to what I would have identified as some resistance. This looks like support back here. If we ran the chart further back, we are very bullish on commodities over the long term going forward. This is a breakout from a decade plus bear market. Commodity bull and bear markets tend to run in multiple year increments. Baltic Dry Index, it went to just stratospheric highs relative to recent history. Came off the boil a bunch, kind of been bouncing back up here of late. This is the shipping of bulk commodities over the world's oceans, tracking the price of that. And then lastly, the cost of shipping a container from Shanghai to Los Angeles, that's rolling over a little bit. So again, very, very expensive historically. We still know that there's a whole fleet of cargo ships waiting in the ocean to port. But nevertheless, we are seeing some relief, at least in the price of getting it from there to here. So folks, went a little longer than I thought. I have some notes I could just rush through, but I think I'll just go ahead and stop it there. You get the picture. Kind of overall mixed macro conditions, but positive on balance. Certainly, we don't have the big trend that we had, coming out of COVID. There's definitely been a slowing of growth as you can see on our index chart. But all in all, there's no reason to lose any sleep over the fear of recession at this point. I will say this, and you're going to see this in the next presentation. The market is showing us some pretty precarious signs, and I've been showing you that in the last few videos as well. The breadth and some of the technical look of the market as well. And there's this thing called reflexivity, and it is real. And these market levels in the U.S. stock market in particular, in some very concentrated places, Yeah, there's some real downside risk there that could turn into something systemic. The American consumer has more of his and her net worth tied up in stocks these days. So if we did see a big stock market, rollover, and it was consequential, that could do a real number on the economy in a reflexive standpoint, meaning if the economy is so levered to the stock market and the stock market takes a big hit, we could see macro conditions come down in very rapid fashion over the course of just a few months. So I'm not making a forecast, folks, but I'm concerned with some of the things I'm seeing, particularly going into next year. But again, I'm going to give you more food for thought there. And also, just to reiterate, though, we are allocating in a way that expresses our longer term macro view, and we see real opportunities there. But because of these short-term dynamics, we have beefed up our hedging activities as well. And I'll probably give you some of that detail here in the next video. Thanks, folks, as always, for watching and listening. Talk to you very soon. Bye-bye.